This video is brought to you by TogetherBudget.com. Alright, let's dive into the world of shares and stocks. So, what is a share or stock?
Haha, that is wild. A share or stock is essentially ownership in a company.
Exactly. When you buy a share, you're buying a tiny piece of the company. Phew! You own a part of it.
That's right. And just like owning a house, your ownership comes with voting rights and a claim on the company's assets.
Wow, you're really bringing out the home equity loan analogy. Ding ding ding.
Hey, someone's got to make it relatable. But seriously, understanding shares is key to grasping the stock market. Now that we've covered what a share is, let's talk about types of shares. What are some of the most common ones?
Aha! Well, there are a few main types: ordinary shares, preference shares, and employee stock options.
Okay, that's a great starting point. Can you tell us more about each of these?
Right. Ordinary shares give the owner voting rights and are the most common type of share. Whoosh! They're like the stock.
Alright, got it. What about preference shares?
Preference shares have a higher claim on dividends than ordinary shares, but they usually don't come with voting rights. Ka-ching!
That makes sense. And what's the deal with employee stock options?
Employee stock options allow employees to buy company shares at a lower price, usually as part of their compensation package. So, what do you think is the biggest misconception people have about shares?
Oh my goodness, exactly. I think a lot of people believe that buying shares means they'll be rich overnight.
Haha, yeah. The lottery ticket mentality. Ding ding ding.
Right? Investing in the stock market is a long-term game. You need to do your research and have patience.
That's so true. It's not about getting rich quick, but building wealth over time through steady growth. Alright, let's dive into the world of stock exchanges. Imagine a huge trading floor where people are buying and selling stocks like it's a game show.
Haha, that is wild. I never thought about it that way. What's the main purpose of these exchanges?
Ka-ching! You get the idea. But seriously, these exchanges are like a big matchmaker service for investors.
Oh my goodness, exactly. I never thought about it that way. How do they decide which stocks to list?
Ding ding ding. Ah, great question. Market indexes are like a report card for the overall market.
Heh, true. I've always wondered what they were and how they're calculated.
So, you want to know what a brokerage account is?
Yeah. I've heard it's like a magic wallet for your money.
Ha, not exactly, but close enough.
Okay, what makes it special?
A brokerage account is a type of financial account that allows you to buy and sell financial investments, like stocks and bonds.
Whoosh. That's a lot to take in. So, where do I get one?
Ka-ching! You can open one with a brokerage firm like Fidelity, Charles Schwab, or Vanguard.
Those names sound familiar. What's the difference between them?
So, let's talk about investing in stocks. What do you know so far?
Something about cows and land? Phew. I'm kidding, that's not it.
Ding ding ding. Ahahaha.
Okay. Seriously though, how do I buy stocks?
Well, when you buy a stock, you're essentially buying a tiny piece of that company.
Oh my goodness, exactly. Like owning a piece of pizza.
Yes, something like that. You can buy stocks through your brokerage account by placing an order to buy or sell shares. Now, let's talk about some of the key terms you'll need to know when investing in stocks.
Oh boy, I'm ready. Hit me with it.
Whoosh! Okay, so first up is diversification.
What does that mean?
Diversification means spreading your investments across different types of assets to minimize risk.
Haha, that's like not putting all my eggs in one basket.
Exactly. You want to have a balanced portfolio with a mix of stocks, bonds, and other investments. Alright, let's dive into some of the most common stock valuation metrics. Price to earnings, or PE ratio, is probably the most widely used one.
Exactly. It's like a report card for stocks. But I've always wondered, what does it actually tell us?
Phew. Okay, now that we've got PE out of the way, let's talk about dividend yield. It's like a coupon book for your stocks.
Huh. I love it. But seriously though, how does it work?
So basically, dividend yield shows the ratio of annual dividends per share to the stock's current price.
Oh my goodness, exactly. Like a discount on your stock purchase. I want in.
And last but not least, we have the price to book ratio. It's like a value meal for stocks, you get more bang for your buck.
Haha, that is wild. I'm loving this stock market analogy fast.
Yeah, it's all about finding the hidden gems. But seriously though, PB ratio shows how much investors are willing to pay per dollar of book value.
Okay, got it. And what does that tell us?
So, let's dive into the world of IPOs. An initial public offering is when a company decides to go public for the first time and sell shares to the general public.
That makes sense. I've heard of companies going public before. It's like they're opening up their doors and saying, hey, we're big enough now, come invest.
Ka-ching. Ah, exactly. And it's a huge milestone for any company. But what people often don't realize is that when a company goes public, they can raise a lot of capital quickly.
Wow, that's true. I mean, think about it, if Tesla went public and raised $10 billion, that's a huge influx of cash for Elon Musk to play with.
Exactly. And with an IPO, the company can use that money to expand their operations, pay off debt, or even invest in new technologies.
That's so cool. But I'm sure there are also some downsides to going public, right?
Absolutely. Going public can be a lot of work for the company, and it also means they'll have to deal with increased scrutiny from investors and regulators.
Okay, let's move on to short selling. I've heard of this before, but I'm not entirely sure how it works.
Short selling is a bit more complicated than some of the other concepts we've discussed, but basically it involves betting against the stock market.
Betting against the stock market? That sounds like a recipe for disaster.
Phew. Ah, don't worry, it's not as scary as it sounds. When you short sell a stock, you're essentially borrowing shares from someone else and selling them at the current market price.
Oh my goodness, exactly. And then if the stock price goes down, you can buy it back at the lower price and pocket the difference.
That's right. But here's the thing, if the stock price goes up instead of down, you'll end up losing money because you'll have to buy it back at a higher price. Alright, last but not least, let's talk about options. This is a bit of a wild card in the world of finance.
Haha, that is wild. What do you mean by wild card?
Well, an option gives the buyer the right, but not the obligation, to buy or sell a stock at a certain price on or before a certain date.
Whoa, that's deep. And I'm sure there are lots of nuances to options trading.
Ding ding ding. That's right. Options can be used for speculation, hedging, or even income generation.
Income generation? That sounds like a good thing.
Absolutely. With options, you can earn money by selling them to investors who are looking for a potential profit opportunity. So, let's dive into some common mistakes to avoid in the stock market. One of them is emotional investing.
Emotional investing? What do you mean by that?
Ka-ching. I mean, you know how people get all excited when the market's rising?
Heh, yes. And then they start throwing money at it like there's no tomorrow.
Exactly. They're chasing after hot stocks without doing their research. It's like trying to time the perfect moment for a jump shot in basketball, it rarely works out.
I think another common mistake is not keeping track of fees and commissions.
Phew. You're preaching to the choir here. those fees can really add up over time.
Yeah, it's like trying to run a marathon with an extra 5-pound backpack on, you'll never reach your finish line.
This tutorial is brought to you by Malik Abwalzate.